So today on the show, I want to share with you what I consider the rules of the game if you want to play in the gray when it comes to your taxes. There are a lot of folks who will go and say, hey, I know it's not black and white. Certain issues are black and white, but a lot of people will say, hey, when there's a gray area in the tax code or when there's a quote unquote loophole, I want to take advantage of it. And this is my message out there to those who are wanting to dabble in playing in the gray areas of the tax code. And this is where a lot of those tax strategies you hear about on social media will live. The gray area is in how they are applied and how you can use them in your business. Now, not every tax strategy, not every, tactic that we use in our taxes applies to everybody. We've talked about this before on the show. But I've mentioned before on this episode or on this show before that a lot of accountants take conservative approaches to taxes. And I've explained why. And my opinion, I don't have any empirical data, but my opinion on why people like accountants don't like to play in the gray is because if it gets caught, quote unquote caught, and if the IRS disagrees with your evaluation, then it's a lot of time consumed. It's a lot of energy. It's a lot of risk potentially for them if it's discovered that something was, they think there's intent to mislead or something like that, or there's something messy going on. The accountants are typically very conservative and very risk averse. And coincidentally, a lot of entrepreneurs are not as risk sensitive, and they want to take these risks because they see high risk, high reward. Okay. But when it comes to taxes, the concept of high risk, high reward can be true, but we have the opportunity, and this is what I want to cover in today's episode. We have the opportunity to reduce risk without reducing reward. Okay. And reducing that risk is a function of being prepared to play in the gray, coming with the tools, coming with the equipment, coming with, if we talk about playing in the gray, coming with the toys, coming with the weapons to show up to the game. And we want to make sure that we are ready to play in the gray. What does that look like? It comes as no surprise. What I'm going to say is documentation. Of course, you're going to have to document everything that you are trying to accomplish. You're going to have to document a really solid business case for why you want to make the decision that you are in sort of playing in the gray areas. So let me give you an example of playing in the gray. This is one of my favorites actually, because I've done this before with a client. We talk about this all the time. Us tax pros will nerd out. Ask my friend Jessica Smith. She's Tax Savvy Jessica on Instagram. She's hilarious. And she's one of my besties in the tax world. We could go for hours, literally bringing up tax cases and bringing up examples of tax deductions that people want to take, that we come up with these most random scenarios of when they could actually take it. So here's an example: clothing. So many of y'all will DM me, can I deduct clothing? Okay, let's talk about it. An accountant, if you ask any accountant, their gut reaction is no. My gut reaction is it depends, which is what it always, every answer, by the way, is it depends. Every answer. But what does it depend on? Okay, let's talk about this. When is clothing deductible? Clothing is deductible when it's used exclusively for business. There's a very clear business case as to the purchase of clothing. It cannot benefit you outside of the business purpose. It can't be normal streetwear. It would probably have to have your logo on it. It would have to be branded, or it would have to be purchased with the specific intent of an event or something so extravagant and different that it wouldn't be wearable as streetwear on a normal day. Okay, cool. So, okay, Shannon, so what you're saying is it's not deductible. No, that's not what I'm saying. I'm saying that it has to meet all those criteria. I actually have a couple clients where they deduct some of their clothing. Here's how they do it. So I have a client who does keynote speeches. She goes on stage, and in particular, she wears what I would consider outfits that borderline on costumey. They are they're of rare material. They're of very fashion forward. We'll say that. She looks like she could have just walked off a runway. She likes to do that to shine her personality through with the clothing she wears. It really is truly like a uniform for when she's speaking, because when she's at home with her kids, she sure as hell is not wearing that to any other day of the week. In fact, she rents a lot of the clothing she uses when she goes to speak because she only uses it on stage and for the event. And then she will turn it back in or she will repurpose it. She very seldom wears this clothing outside of social media filming and keynote speeches. But the clothing is of such a variety that you would not expect. It's something that like would come out of the Met Gala. Some of the stuff, not quite literally, but it feels very much like a one-time award show type of garment. And we say, you know what? I can make a case because I'm comfortable enough. I would be willing to sit across the table from an IRS agent, given this person's business model, and look them in the eye and say, I think this is fair and reasonable that she's spending this much money on clothing because she is on stage so frequently. It's a function of, are you really going to make a case as to why you are spending this money because you are in business and you would not have spent it otherwise? Really? Can you tell the story with conviction that, no, absolutely, this is deductible and here's why? Can we make a case for it? And then the other question is, are there any precedents? Precedents meaning, are there any instances of someone before you successfully deducting this? Now, that's always tricky because it doesn't, not everything is a precedent. Not everything can be leveraged to say like, well, they did it, so I can do it. It's really hard because circumstances will be different. But in this example, playing in the gray means coming to a decision together, me as the accountant, her as the founder, and saying, let's just talk through this for a second. You know, would you be buying this? Would you be going to these stores? Would you be ordering this garment if you weren't doing this activity? Absolutely not. I wouldn't. Okay, so there's one factor. The other factor is of what variety it is. Where would it benefit you? Are you taking this home and putting it in your closet at the end of the night? No, not really. Okay. So then I think we could pull this off. Like, I think we could argue that this is deductible, even though traditionally the IRS would say clothing is not deductible unless it has your brand on it. Under the argument that it's ordinary and necessary as an expense for her business, I would say yes. She's also paid for these speaking gigs, by the way. So I think that it makes total sense. Now, this is me. I'm not telling you you can go do this. I'm not telling you that your accountant is okay with this, but this is between me and my client. And I said, hey, this is where I think we could kind of play in the gray here. Let's look at the magnitude of expenses and make sure it's reasonable and not extravagant or lavish. And as long as it's not a lavish expense in terms of the volume or the dollar value, then I think we have a good case here. I also don't think the IRS would really question it because it's not of a magnitude that they would really care all that much. So when you add all these factors together, it increases the likelihood of us being able to deduct this successfully, lower the risk of an audit or a clawback of this deduction, and it enables us to be able to move forward confidently. So there are going to be examples in your business where you're going to want to play in the gray. You're going to want to take advantage of deductions that you've seen on social media. You're going to hear about these from your friends. You're going to say, hey, I want to do that too. How can I do that? And yes, that is a great question to ask your accountant. But the first thing to do is sit down with them and go, if this were questioned, how could we actually compile a solid business case as to why this is going to be a legitimate deduction? Because if you come to the conclusion that we have a really weak case, now it's a question of risk tolerance. Now it's a question of, hey, it's a coin flip. We could basically take the deduction and run the risk that they'll disagree with us, or we could not take the deduction and essentially surrender and not bother. And the decision you make in that situation is totally between you and your accountant. Because, and I always tell my founders this too, even when it's with me, I go, I call it the give a shit fence. I go, I'm on the give a shit fence. I just don't care either way. Like, you could deduct it and I'm cool with it and I could make a case. And it's also not of a magnitude where I would be heartbroken if they clawed it back. If they said, hey, we're going to disallow this deduction, I'd be like, all right, fine. I also don't care enough to say roll the dice and let's take it. It's not going to be of a magnitude to move the needle for you either. So when it's not worth moving the needle for your tax situation and you're only going to save a couple $100, I would say that you want to say, okay, well, is it worth me going through this extra trouble? Or is it worth me starting a conversation with an auditor over this? Again, it's just on that fence of maybe not. So when you look at your tax situation, when you look at your expenses and your deductions with your accountant, understand that it would have to have a compelling argument as to why this makes sense in a business case scenario, but also why you should be deducting it and why you want to be deducting it from a magnitude and impact perspective. Because if you're not going to move the needle with it, then why are we even bothering? We want to be focusing all our energy on the things that will move the needle forward in our business. And as I always say, you want to have an earner's mindset. You want to be working on, how can I earn more money? How can I make more money? How can I make enough money that taxes don't even matter? And how could I focus on that instead of trying to claw back every dime? I'm stepping over dollars to pick up dimes at a certain point when I'm talking too much about my tax strategies of deductions. And we're talking about deducting Botox, or we're talking about deducting one trip to the grocery store, or one instance of going to rent the runway, or one garment, or whatever. When we're talking about one thing at a time, we're also wasting time that could be spent selling. And then negating it anyway. So think about that, like where you're spending your time and your energy, and just kind of, I would say, pick your battles, roll with the punches, pick your battles on what you're going to be focused on, what you want to be strategizing with your accountant. Go after the big ticket strategies, but the rest of it, I would say, it might make sense to play more conservatively in certain situations and then play in the gray for the bigger stuff that will really move the needle for you, where you can compile a really solid business case. And we'll go back to that business case in just a second, right? The importance of a business case is that you're able to articulate in the context of your business how this is deductible or how this should be allowed as a deduction on your tax return. So when you're making this business case, you have to clearly articulate, be able to clearly articulate and share with someone. Literally, guys, you have to be able to explain to a third grader. I'm not kidding. I've been through enough IRS audit interviews to understand that, and I'm not knocking the IRS's intelligence here, but I will say this, the IRS and the people who work there generally do not have a solid understanding of digital businesses. They don't have an understanding of, the type of work that most people are doing right now in the modern economy. They have a pretty good understanding of manufacturing. The tax code is written around manufacturing and around retail and other things. They know more about the businesses they tend to interact with. But if you think about a 9-to-5 employee working at the IRS, they're probably not working with entrepreneurs of your caliber. So you have to then go, okay, I have to be thinking about, how can I articulate this? How can I explain to someone through the use of stories, analogies, relatable examples, and other things about my business? How can I explain to this person who knows nothing about my business about how this is deductible? And I'll give you another example. I went through an IRS audit recently, and we were bringing up advertising and marketing expenses related to my clients' social media content. Now, this particular person who was the auditor had no social media, and which seems so weird, right? It's like, and this person was not, I will say they're not like of an older generation. They're probably a millennial, Gen X. And they said, oh, I don't have an Instagram. I don't have a TikTok. I don't have a Facebook. I'm like, what? So she knows how Facebook works. I think she had a Facebook at one point, but she didn't understand how it related to business. She's like, so she's sharing pictures on Facebook and she's like getting new clients. And I'm like, kind of. And I literally had to explain to someone almost like it was a time warp, like a time capsule from 2002, and say, this is what social media is used for now. And I had to explain it. I had to show examples, and I had to pull up my profile. I had to pull up other people's profiles. And I said, see what we do here? Like, we make videos and we do this. And she's, oh, wow. Okay, cool. Now I understand. But you have to remember that, like, they're not on your wavelength. They don't understand what you're talking about when you say how you use these things in your business. So you have to meet them where they're at too, and be prepared to be able to explain that. So when we're talking about taking deductions, when we're talking about playing in the gray, what we're really talking about is, how well can you tell this story if you are asked by somebody who has no idea what you're talking about? Like caveman or alien drops down and says, what do you mean you do social media marketing? Like, what does that mean? And you have to be able to explain it in an articulate way. So chances are, if you are working with an accountant and they are turning down the ability to play in the gray, it's for one of two reasons. One is that they just feel like it's too risky from their perspective. They don't want to put their name on it because they don't want to risk their license over something. And that's fine. I respect that. But the other reason might be, if I'm being totally honest, the other reason why might be because they're not confident enough that you and them can make that business case in a really strong way. And what you have to be able to do is evaluate and be honest with them and ask the question, for example, hey, do you think this is legitimately because of something in the tax code? Or do you think this is just an inability for us to make a case and communicate that? Because in all honesty, if it's the latter, then you might just need a new person to make that case for you, or you might need to find someone who matches your risk tolerance. If you're willing to take that risk and willing to tell that story and say, I can make the case for it, then I think you need to meet in the middle and come to that accountant and say, hey, I'm willing to do this. I can make this case. I'm ready to play in the gray. But if they don't want to show up with you, then that's a conversation. But this is also a great way to tell who's a good person for you to work with, because you have to have matching risk tolerance. You have to be able to be equally committed to the stories you're telling and the way that you're explaining your situation in the case of your tax return. You want to make sure that you're in line with how it's being presented. So if you want to play in the gray, which I welcome everyone to do if they want to, play in the gray, just know that you can equip yourself with the right tools to minimize risk and to make sure you walk out with it being a little bit less gray at the end.